Alright, so we're going to continue through with our risk. Remember we've been through quite a few risks. We started with interest rate risk and then liquidity risk, price risk, credit risk. Last session we handled basis risk and model risk. And so here what we want to do is get into the next risk, a short one, not a lot of detail here, but it's a very, very important one, which is legal risk. Legal risk is you have a contract and it's interpreted in a way you didn't expect, or it can't be enforced. I think it's really important anytime you sign a contract, one of the main purposes of a contract is to assign risk when something goes wrong. Who takes responsible, who pays, who takes responsibility, who pays. I used to live in an apartment complex, and they would give me the lease, and I actually read my lease, and it's really amazing in an apartment lease how much risk they shift to the tenant. I actually had to sue my apartment management for some of the things they did that weren't in the contract, and I won the lawsuit. I think I was the only tenant suing a landlord. Everybody else in the courtroom was a landlord suing a tenant. But I read the contract very carefully, and I just was not going to accept some of the risks that they were shifting to me. So that's an important part of a contract, and sometimes I've seen firms where they'll sign a contract because they needed to get it done. Everybody's eager just to get it done, and they'll accept language that in an extreme situation they're accepting risk that is really quite unnecessary. It's a risk that they shouldn't have to accept. They're not getting compensated for taking that risk, but because they're desperate to sign a contract, it was a very remote possibility. They said, sure, whatever, we'll sign it. And then when that thing happens, like in a coronavirus environment, or the financial crisis of 2008, or the dot-com blow up, or oil prices falling in half, something extreme happens, and then you look at the contract and you discover that, oh my word, we bear the risk of that loss. So that's the definition. There's many examples of it out there, but it's not really necessary in this class to get into them. I do hope you were paying attention in your business law class. I was amazed in my job in finance how many legal contracts where I drafted 70–80% of the contract, and lawyers just threw in some boilerplate language at the end. A lot of financial contracts are so complex. We talked about it some when we're looking at the swap contract. Very complex language, and the lawyers do not understand, usually don't understand that language. They're not finance people, and so definitely you want to make sure you know. The best thing to do on a contract, and we'll talk about this on the mitigate, is know exactly what you want. List that out and make sure you go to the extremes. Ask questions. Who pays if this happens? What do we owe if this happens? And think through those scenarios, including extreme scenarios that have never happened before, and walk through them. And if you don't understand the language, then maybe at least document. If the lawyers won't change the language, if there's some boilerplate language, then at least document that I talked to their lawyers and their lawyers agreed that this is the correct interpretation of this language, and keep that by your side. So if something does go wrong and someone says, no, that's not what the language means, you have something with that's emailed to them that you can tell that they read it. So just think of the extremes. Risk is most important at the extremes, and contracts shift risk. So you need to walk through your contracts thinking about what happens if. How do you measure it? That's almost impossible, but how many pages is the contract? And then how complex is the language? So when I showed you the swap contract in class, you saw how complex that language was. Yeah, that's an extremely high risk, because you got a contract that's 20–30 pages and the language is extremely technical and poorly written by lawyers who are intentionally overusing words, throwing a bunch of long terms, a convoluted sentence structure. My suggestion is tell them exactly what you want. Try to shorten the contract down. Think through what is it that is most important to you. So the mitigate is make sure you use the language that clearly states what you want. Ask a lot of questions. Don't be shy in these environments. I got pretty good at this later in my career of asking questions, even though they might have been bizarre questions. Like, what happens if oil prices fall to $10? What happens if the 10-year Treasury goes up to 15%? What happens if Morgan Stanley goes out of business? And sometimes they're awkward questions because you're talking to a firm. I remember Lehman Brothers called us to do a structured debt, and Lehman was, this was in 2008, Lehman was still in business, but people were worried about them. And you have no choice but to ask, well, what happens if you go insolvent? They may be offended that you ask that question, but you've got to go to the extreme. Don't trust lawyers. Lawyers are not trained in finance. They're trained in other areas. There are some lawyers that have some finance background, but they still tend not to be nearly technical enough. They are trained to sound like they know what they're talking about, but many have very weak backgrounds in these complex financial transactions. If you can find a lawyer that has a lot of background in that particular transaction, that's great. We'll talk about disclosure risk. I was very fortunate at UTSA that we did have some accountants that had strong backgrounds in some of the areas I was looking at. But mostly you will find lawyers that don't have a strong background. Now, I've had some finance majors go back and get a law degree. And I tell them it's a great idea, but boy, I would specialize. We desperately need lawyers who have a strong understanding of some of these very specific, complex contracts. But I don't think there's many moving into that area. Maybe there's just not enough work if you're too specialized in legal. But at least find 4 or 5 contracts that you specialize in, that you can be the expert. Contracts that, like interest rate swaps is a good area where there's a lot of weakness. There's just not much legal expertise out there. All right, so that's legal risk. Let's talk about disclosure risk. Now, disclosure risk has become a huge issue after the Dodd-Frank and after some of the Enron issues and new legislation requiring firms to disclose more and more information and to actually have management sign off that the information that's being disclosed is accurate. So here's where you cannot manage a risk because the complexity of the reporting or other compliance requirements just make it impossible, whether it's legal or regulatory or accounting. I didn't put accounting in here, but I should have put accounting in here. I'm going to add that. That's an important one. We talked about FASB 157. FASB 133 is an important one. There are some accounting standards that you as a finance major, if you're an X-ray major, probably doesn't apply to you, but if you're a finance major, you need to know these financial standards because they may prevent you from doing what you want to do. I remember the first time I wanted to do interest rate swaps and options, my boss walked over to me with 2 books. Each of them was a good 3-4 inches thick. Put them on my desk and said, "Here, read this." And it was FASB 133, which FASB 133 is on accounting for derivatives. And you have to understand between a cash hedge and a price hedge, and just exactly when do you have to mark to market, when don't you mark to market, if what you are hedging is mark to market, but what you're using to hedge with, the derivative, is not mark to market. What does that mean? We're going to talk about that when we talk about the MG case later and how the accounting really caused a lot of uncertainty for the firm. So yeah, you do yourself a big favor by knowing the details here. Those finance majors that are willing to understand the legal environment, the regulatory environment, the accounting environment, for their particular area of expertise, they have a huge advantage over the competition. How do you measure it? Well, how many pages is the regulation? How many pages are the rules, the complexity? When my boss walks over with 2 huge books for FAS 133, what that tells me this is very complex. And I started reading them, but I'll tell you how I mitigated this. So how do you handle this? Well, first, you get the legal, you get to accounting, you get to the regulatory department as early in the process as possible. I know a lot of finance people do the exact opposite. They're so worried legal or accounting is going to shut them down that they put them off to the very, very end, so that it's a pressure. You've got to get this done. I got to get this approved next week. That is not the way to do it. There's no question legal and accounting can slow you down. There's no question they can shut you down. But for your protection and for your firm's protection, get them involved. Give them some time, especially when these things are so complex. And their review will take longer than expected because they have full-time jobs already. That's been my experience with legal and accounting. They already have full-time jobs. You're bringing them overtime work. So great respect. Wow, I try to make these people love me as much as possible, just because, I mean, they were great people. I loved working with them, but also I needed them to do their jobs so I could do my jobs. And what I was asking them to do was extra work. You hire people, you spend a lot of time reading and thinking about these different scenarios. You might actually hire even lobbyists. Lobbyists have a bad reputation, but I can tell you corporations, they use lobbyists to shut down really bad legislation, and they're quite effective. They're quite powerful in what they do. So there will be times when great ideas are killed just because the disclosure requirements are too onerous. So DoddFrank is a good example. Here's an Economist article. I don't know if this link still works. It's a few years old, but I took this out right when DoddFrank had come out, just so you could see just how massive DoddFrank is. It's a massive regulation. It has huge costs. It's very complex. The law itself is 848 pages long. I think this is just interesting here. The law that set up America's banking system in 1864 was 29 pages. We set up the Federal Reserve with a law that was 32 pages. The Banking Act, the Glass-Steagall Act, was 37 pages. DoddFrank is 848 pages. The Affordable Care Act, I think, was over 1,000 pages. Legislation has gotten so complex that you really have to ask the question, who's actually writing our laws? I don't think it's our legislators. They're not the elected officials. Our laws are being written by consultants and bureaucrats behind the scenes, and there's a tremendous amount of boilerplate language that is being thrown into every law. I remember with the Affordable Care Act, I saw people who didn't like it that were posting stuff from the language, and it was just completely fabricated. But the law was so complex, no one really knew what was in it. And you could copy and paste stuff out of the law completely out of context and scare people to death. But when you look back in context, you see that's not even close to what that's saying. This is complex stuff. Do any of y'all really want to read a 848-page regulation? Now, there is a book that I really like, and I didn't put it in here, but it is my reading list. It's a book I highly recommend. It's called Regulating Wall Street, and it's by some New York Stern School of Business professors. Very good book. Look in my reading list. You'll see it in there. It's a book about the Dodd-Frank bill, which you might think, wow, that's really, really boring. But we might have talked about this earlier in class, but actually it could have helped you a great deal on paper one. There's a lot in there about how banks manage risk and what the best way to measure that and to mitigate that is. And so this is a book I highly recommend. But as you read through this, I won't read this to you, but Dodd-Frank was written for bureaucrats. It actually, what it's doing is giving bureaucrats the authority to write more rules. So it's not 848 pages of rule. It's 848 pages of instructions to bureaucrats to write thousands of pages of rules. So 383 explicit questions and 1,420 sub-questions. Dodd-Frank mandates 87 studies. No one knows who's going to actually look at all this stuff. Financial institutions are being smothered. I remember one lady I worked with at USAA, very, very impressive lady, really liked working with her. She knew our USAA bank very, very, very well. She went part-time, 20 hours a week. So last time I saw her, I asked, what are you doing? And she said, my entire job is Dodd-Frank. That's all I do. And I thought, wow, I didn't tell her that, but I thought, what a waste of talent. That is her only job is to make sure this bank complies with Dodd-Frank. Someone who could add tremendous value in any firm with her knowledge and her work ethic, but her entire job was to execute this new law because it was so complex. It does encourage gaming of the system, so a lot of firms are not trying to comply with the law. They're trying to figure out how they can do what they want to do and get around the law by, somehow complexity of what they're doing or find some loopholes. So overall cost is pretty staggering. I know President Trump pulled back on some of this. There's some debate on if he pulled back on the stuff that was actually working and kept in the stuff that wasn't or not. Who knows? But it is an undaunting law. Here's what Dodd-Frank does for risk management for banks. It sets more standards related to risk-based capital requirements. Obviously, banks already had that. If you read the Basel Accords, very important if you're interviewing with a bank, come talk to me and I'll show you the kind of things you should be reading. But capital requirements, those are part of the law. The leverage limits, how much short-term debt you have, liquidity requirements. We talked about liquidity and the importance of that. Having a resolution plan, essentially a living will for banks to talk about what are they going to do if they die, how are they going to work out of their disaster, concentration limits, a contingent capital plan. How are you going to issue new stocks? How are you going to get capital if you're under your capital requirements because of huge losses? New disclosures, which are just unwieldy. Some other overall risk management requirements. So the question is, does it actually address too big to fail? And most say no, that it really didn't address that. So would Dodd-Frank have actually prevented 2008? And I think most people say no. It makes bureaucrats and politicians feel good that they did something, but it's so convoluted, so complex, so many pages of regulations that are being filed with the federal government, and who knows who's actually reading through all of that. So it is definitely a mess. Not something I'm a big fan of, just working in companies. I've dealt a lot with regulators throughout my career, and I was always shocked at how far behind they were in just what's going on in the markets and technology. They're smart people, but they're very limited in their time. Usually, if someone's going to become a regulator, it's usually because they weren't maybe the strongest people in their class. The strongest ones are working for Goldman Sachs or JP Morgan or Morgan Stanley, making 7-8 digits. The ones that are going to become regulators, either they have a passion for that or they don't want all the stress of those jobs. So there are some smart people in there, but it also tends to be people who could not make it in the high stress world of Wall Street. So they become a regulator. And so, I was shocked at the regulators. Many of them just did not know modern finance and modern portfolio theory. All right, so there's a lot more we could talk through there. Let me tell you how I handle this on the disclosure side with derivatives. We'll talk about tax risk next, so I'll talk about how to handle tax risk. But the accounting risk, as I said, I went to the accountants early. My good friend Kristen was our corporate controller. I would go to her and say, I have these risks. Fortunately, when I started doing a lot of interest rate swaps and options, USAA had just hired a new accountant from Pete Marwick, I think, and that was his area of expertise. And so fortunately, I could just sit down with him and say, what's the accounting going to be like? He walked me through the scenarios just like I like to do. What if interest rates do? What if the stock market does this? What will the accounting be for this? And he walked me through it. Because I was doing a lot of my transactions inside of the pension plan, that protected me because pension plans were already fair value accounting. They already had everything I wanted. I wanted fair value accounting. I wanted my derivatives to move in lockstep with my liabilities to offset that risk. I mean, when my liabilities went up, I wanted my swaps to be up. I wanted everything marked to market so as to protect the net worth of the firm. And he walked through each one of the scenarios. He was very knowledgeable. It saved me a tremendous amount of time. But if USAA had not had that employee, they would have had to assign an accountant to me, and the two of us would have sat down and go through those FAS 133s together and would have had to figure it out. So you start very, very, very early. They used to dread seeing me coming because they knew some new complex question was coming up. But boy, I encourage you, um, take advantage of time and get there as early as possible. All right, I'm going to stop it there because the video is getting a little long, and we'll talk my next issue, which is one of the most frustrating ones, and I'll talk about my experience with tax risk because it can be a showstopper.